Hey, ladies and gentlemen, welcome back to the channel. Market participants ran a gauntlet of robust data on Thursday, which showed the good news/bad news economic resiliency amid restrictive Fed policy, which could encourage Powell & Co. to keep rates higher for longer. The U.S. economy grew at a 4.9% quarterly annualized rate from July through September, according to the Commerce Department's first stab at third-quarter GDP, US GDPA equals ECI. The number landed 60 basis points to the north of consensus and marked a robust acceleration from the second quarter's 2.1% growth, showing an economy more resilient than the Halloween villain. It was the strongest quarterly GDP reading since Q4 2021. Consumer spending and private inventories carried the day, together contributing 4 percentage points to the plus column. Digging behind the headline, a 7.6% jump in spending on durable goods, with imports and exports growing 5.7% and 6.2%, respectively, are among the eye-openers. The UAW strike made itself felt. Excluding vehicle output, GDP grew at 5.3%. All in all, however, the robust economic report isn't entirely good news, at least not for the Fed. Economic growth transitioned from resilience to re-acceleration this quarter, defying the Federal Reserve's aggressive tightening cycle and tighter financial conditions, writes Olu Sanola, head of U.S. economics at Fitch. The bottom line is that the staying power of this growth spurt is questionable going forward. Above-trend economic growth cannot sustainably coexist alongside an increasingly restrictive interest rate environment. The Fed's higher for longer message may turn out to be much higher for much longer. But consumer spending, which accounts for about 70% of the U.S. economy, was the clear star of the show, growing by 4% and contributing 2.7 percentage points. As usual, outlays for services dominated, adding 1.6 percentage points to the plus column, with durable and non-durable goods contributing 0.6 and 0.5 pps, respectively. The strength of consumer spending and the boost to growth from government spending does not make the Fed's job easier over the coming quarters, Sanola adds. Speaking of goods, new orders for durable goods, USDGN equals ECI, which includes everything from waffle irons to fighter jets, surged by 4.7% last month, blasting past the 1.7% analysts expected. Drilling down into the report, a 92.5% jump in commercial aircraft eased the pain of a 14.4% drop in defense orders. Core capital goods, which excludes defense and aircraft items and is considered a barometer for U.S. business spending intentions, increased by 0.6%. Much stronger than the paltry 0.1% gain projected by economists. However, the bigger picture is that core capital goods orders continue to trend lower in real terms, in line with depressed capital spending intentions in the survey data, says Kieran Clancy, senior U.S. economist at Pantheon Macroeconomics. This weakness has been partly offset by rising business purchases of autos in recent quarters, but spending here also appears to be slowing. Pivoting to the labor market, 210,000 U.S. workers joined the unemployment line, US job equals ECI, last week, a hair more than analysts anticipated and a 5% increase over the previous week. The Labor Department's jobless claims report appears to reflect employers' reticence to hand out pink slips willy-nilly at a time when many companies are struggling to fill open positions, according to recent survey data from ISM and NFIB, among others. Ongoing claims, US job equals ECI, reported on a one-week lag, surged by 3.6% to 1.79 million, well above the pre-pandemic average, which could suggest that it's taking longer for laid-off workers to find new gigs. The upturn in continued claims suggests that, while the labor market may be characterized by few job losses, unemployed individuals are finding it more difficult to find new jobs, which would be consistent with a slower pace of hiring, says Nancy Vanden Houten, lead U.S. economist at Oxford Economics. And now for some housing data. Signed contracts for the sales of pre-owned U.S. homes, USNR equals ECI, defied analyst expectations by rising 1.1% last month, according to the National Association of Realtors, NAR. Estimates called for a 1.8% decline in the wake of August's steeper 7.1% plunge. But don't rent a hall to celebrate just yet. Despite the slight gain, pending contracts remain at historically low levels due to mortgage rates, writes Lawrence Yun, chief economist at NAR. Furthermore, inventory remains tight, which hinders sales but keeps home prices elevated. Mortgage rates, which mirror Treasury yields, are climbing through the stratosphere, with the 30-year fixed contract rate reaching 7.9% last week, the highest level in over 23 years. This has had a double whammy effect. It has nudged the prospect of making monthly payments beyond the realm of affordability for many potential buyers, and it has reduced the inventory of available homes on the market, as owners with much lower rates are unlikely to pick this time to upsize/downsize. NAR's pending home sales report is considered among the more forward-looking housing indicators because signed contracts generally translate into actual sales a month or two down the road. And finally, the Commerce Department released its advanced take on goods trade balance, USBAL equals ECI, and wholesale inventories, USAWIN equals ECI, in September. The report showed the goods trade gap widening by 1.3% to $85.78 billion and wholesale inventories unchanged versus August. If you find this video informative, hit the like button, and if you want more updates on crypto world, make sure to subscribe to our channel. Thank you for joining us, and we look forward to sharing more crypto insights with you soon.